like to welcome everyone to the 12th full TAC committee meeting since we've reconstituted this back in, I guess, July of 2010. And I think out of the 12 full committee meetings, I think we've probably talked about high frequency trading, at least 9 of them. So as you can see, we have a record attendance, including members of the full committee, members of the Data Standardization Committee, and the Subcommittee on Automated and High Frequency Trading. I'm very grateful to have everybody's participation and involvement here to get this many people from around the industry involved in one room to spend the entire day is no insignificant task, and I realize you've made a lot of changes to your schedule to be here, and I'm grateful for that. And I'd like to also thank our witnesses way down at the end of the table who have also made accommodations to their schedule and, of course, had to prepare their presentations to testify and to get this debate going. We also have a number of new TAC members here today, as well as subcommittee members on the data and high frequency trading subcommittees as well. So I'm very pleased that we were able to pull together all of these people, and I appreciate your service. Some of you, this is your first meeting. Turn to your right or turn to your left. There's somebody that's done this before, and what we want is honest, fresh, and direct answers. We have a lot to get through, so your participation is appreciated. You're here because you're an expert, and to not offer your expert opinion would be a disservice to this little organization, so feel free to jump in. So today we have 3 topics on the agenda. First, we will address the issues raised by Michael Lewis's book, Flash Boys, to determine whether these issues he raises in his book have any relevance to the derivatives markets. Second, in light of the evolving and complex market structures related to automated trading, I've pulled together a panel that will offer ideas about how the Commission should design a 21st century surveillance system. Traders do not trade on just one market alone. They trade on many markets, and we need to adapt to that reality. Today, I'd like to discuss key elements of a 21st century surveillance system that integrates swaps, futures, and OTC derivatives data. I'd like to have our witnesses address these cross-market surveillance challenges and identify the key tools that will help us detect fraud and manipulative and deceptive trading practices. Finally, I'd like to receive an update on the state of the swap execution facilities. I'm concerned that the low-level participation by the buy-side firms in CEF trading, and I would like to know whether there are any regulatory impediments that might impact their participation. Now, as to the first panel, Michael Lewis's book has stirred up quite a debate about HFT and market structure. The book claims that equity markets are rigged by HFTs that are front-running other traders' orders. The book raises other issues such as HFTs having faster data feeds, exchanges paying for brokers to take or provide liquidity, and HFTs co-locating within the exchanges. I want to address these issues directly and to have a frank discussion with all of you to understand how automated trading and high-frequency trading impacts derivative markets. I can't think of a better forum to address these relevant market issues. We have 4 witnesses who will offer their opinions on the first panel. We have Brian Durkin, CEO of the CME Group, Chuck Weiss, President and COO of ICE, Joe Saluzzi, co-founder of Themis Trading, and Rob Creamer of Geneva Trading, currently serving as chairman of the FIA Principal Traders Group. Now, for panel 2, we have posed several questions regarding the design of the 21st century surveillance system. What are the essential tools and technologies that the Commission needs to have in place going forward? Should the Commission invest in order message surveillance systems and cross-market surveillance tools? What is the current trader and firm ID protocol, and what additional information, if any, should be required to monitor automated systems? We will start our presentation off, or our panel off, with a presentation. It will be a very interesting panel. This is something we've, for the first time, asked our staff to pull together, and George Harada, the Associate Director of the CFTC's Office of Data and Technology, has put together an outstanding presentation on kind of the state and the opportunity that the Commission has in terms of its data. This is something that we haven't put on essentially one slide to look at all the different data sources and how we're going to integrate them to do our market surveillance. And I think that will provide some context in which then some of our other witnesses can can talk about how we fully integrate that and really develop a top quality surveillance system. After George, Andrew Vrabel, who is the Executive Director of Global Investigations at CME, will present, and Tribute Bland, Vice President of Regulatory Affairs with ICE. We'll hear from Steve Joachim, Executive Vice President of FINRA, to talk about comparable and similar systems in the equities markets. And again, Rob Creamer will be on the hot seat to discuss his views from the FIA PTG Group. And finally, we'll hear from Dave Lauer, President and Managing Partner at Core Group, on his views. Panel 3. The last panel will update us on the current status of trading on the CEFs, and we'll share some of the concerns we have heard from buy-side participants. I'd like to know whether the Commission rules create a barrier to trading on CEFs and force market participants to turn to alternative trading solutions. We have a gentleman from Claris Technology, Todd Skorecki, who will provide us kind of an overview on the state of CEF trading today. And then we'll hear from Wendy Yoon, Managing Director of Goldman Sachs Asset Management, and Michael O'Brien, Director of Global Trading at Eaton Vance for the buy-side perspective, and Scott Fitzpatrick, Executive Director of Tradition, who is also serving as Chairman of the Wholesale Market Brokers Association, for their perspectives on CEFs. Since we have many TAC members that also operate CEFs, I would greatly appreciate any insight they can offer on CEF trading activity today. Again, let me express the Commission, on behalf of the Commission and myself, our gratitude for everyone who took time to come here today and prepared presentations. We really look forward to the rest of the discussion today. With that, I will not recognize Chairman Weegan, who is not here, but who will be here, and when he does, we will recognize him. But in the meantime, I'm going to get started with our first panel, and I think we're going to start with Brian to discuss HFT.
Thank you, Commissioner, and the team from the CFTC. For the last 3.5 years, this committee and the TAC Subcommittee on High-Frequency Trading have examined market structure topics associated with electronic trading in the futures markets. Many respected and noteworthy principles have emanated as a result of this in the context of risk management, pre- and post-trade protocols, system safeguards, access to colocation facilities, and messaging policies, among others, which have added to the integrity, the transparency, and the vibrancy of our markets. This all occurred long before recent media attention on these topics, which is not surprising because the futures industry has a long history of combining self-reflection and innovation to deliver fair and secure markets that meet the risk management needs of all of its participants. The formation of the Technology Advisory Committee and the active discussions that have resulted are just another example of this sense of self-awareness. And I would like to commend Commissioner O'Malia, his team, and the TAC participants over the years, including many of my colleagues sitting at this table today, for all that has been accomplished. Now, algorithmic and high-frequency trading are products of the evolution of markets from a floor-based model to an electronic model. Market participants sought greater price transparency through more immediate trade executions and confirmations, and electronic trading has met that demand. That technological change has been the catalyst for the development of more competitive, more efficient, more transparent markets, as well as substantial improvements in innovation, in risk management, and in regulatory capabilities. As a result, algorithmic and high-frequency trading has grown, contributing to significant volume growth across all asset classes and providing greater liquidity and tighter bid-ask spreads. The liquidity generated by these market participants is, in turn, relied upon all types of market participants, including banks, hedge funds, asset managers, farmers and ranchers, corporations, and commercial producers, to achieve their risk management and their investment objectives, and it allows them to do so at lower costs. Now, despite this progression, as you are all well aware, a particular type of electronic trading strategy has been negatively portrayed by some who assert that the presence of HFT a reference to a style of trading which this committee has expended tremendous effort, I might add, trying to define, is abusive and disruptive to markets, much of which has been based on generalization and misinformation as applied to these futures markets. The fact is that the increased innovation and the speed of electronic trading has challenged us to ensure that our markets operate with integrity and are fair and open to all customers. CME Group has been focused on this task for many, many years, and we've worked closely with our regulators and our customers to maintain a level playing field throughout this evolution. We've created a market structure of which we are very proud of and should be proud of. In particular, we use a central limit order book. It's a single integrated marketplace allowing for concentrated liquidity in one transparent location. The identity of traders and firms is protected from disclosure on all bids, offers, and execution reports. Bids and offers are available to all market participants and are matched according to transparent exchange matching algorithms. Our market data is sent to everyone at once. There are no preferential data feeds that are provided exclusively to a particular segment of user base. While customers have several options in terms of how they can receive data from us, we do not restrict anyone's access. Having multiple connectivity options makes our markets available and accessible to a broader array of market participants. No one can see orders prior to them hitting our match engine and being made available to the order book. We maintain a complete and a comprehensive audit trail of every single message, order, and trade down to the message ID of every participant in our markets. This information is fed into a sophisticated surveillance system that allows us to identify and to prosecute prohibited trading practices that violate our rules. In addition to having built a market structure that promotes liquidity, efficiency, transparency, accessibility to customers from banks, hedge funds, commercial producers, merchandisers to farmers and ranchers, CME Group promotes market stability through industry-leading risk controls. We have developed a wide array of capabilities to manage risk and volatility and to mitigate market disruptions. These are applied to all levels of market participants. These include credit controls. Credit controls are pre-execution risk controls that are provided that enable clearing firms to set credit limits for their executing firms. Our credit controls, which every clearing firm must use, can include order blocking, order cancellations, email notifications, which can be set at varying thresholds. We also employ a tool called Cancel on Disconnect that will cancel resting orders for a market participant who becomes disconnected from our system. We employ price banding. All orders are subject to price verification. Now, bids that are prices well above or offers that are at prices well below the market fall outside of that determined band that we establish, then those orders are rejected automatically. Maximum order quantity. Every product has a predefined maximum quantity per order. This step ensures that the order is not exceeding this limit. And if the maximum quantity is exceeded, the order is automatically rejected. Messaging controls. These controls limit the rate at which firms can submit mass quotes and can block orders from entering our system if volume thresholds or quantities are exceeded. Stop logic functionality. Stop logic can automatically halt the market for a predetermined time period in order to help prevent extreme price deviations. As you all know, when it was triggered on May 6, 2010, it was Stop Logic that reversed the course of the flash crash by halting the market for enough time for liquidity to be replenished and the market to retrace. Volatility logic functionality. This is designed to guard against rapid price spikes. It is triggered by a pre-specified price movement over a short, defined period of time. Like stop price logic, it places markets in a reserve state where orders may be entered, modified, or canceled, but they may not be executed. Circuit breakers. In our equity index and energy products, circuit breakers halt trading for a period of time when a specified price level is reached. In addition, daily price limits prevent trading at prices higher or lower than limits that are preset by the CME. Protection points. Protection points act as a control against excessive price swings in illiquid markets. These points prevent market and stop orders from being filled at significantly aberrant prices because of the absence of sufficient liquidity. And kill switches. These are designed to allow clearing firms a one-step shutdown of all CME Globex activity at the most granular of levels of a market participant. Another service that CME Group provides to the marketplace is colocation. Now, criticism of colocation in some of the public coverage of this issue has failed to recognize that colocation actually equalizes access to the benefits of the speed through proximity. Although colocation requires an investment, it is open to all market participants and serves to level the playing field, unlike several years ago when a firm could gain an advantage by buying real estate near an exchange or where a server was thought to be in a data center. Without the development of our colocation facilities, no one trader may gain an advantage over another. With the development of our colocation facilities, no one trader may gain an advantage over another due to proximity to that match engine. All customers located in our colocation facility are treated equally. That is, they receive the same contract, they receive the same pricing, they adhere to the same policies and principles. This includes redundant, equidistant fiber connectivity to the CME Globex, as well as equidistant cross-connects to telecommunication carriers that get them into and out of our CME data center. Finally, as we are all aware, the futures markets are fundamentally different from the equity markets. Many of the recent complaints against high-frequency trading and the fragmented equity markets simply do not apply to U.S. futures markets. We believe the futures markets strike the right balance of regulating the market without inhibiting true price discovery. And this balance of regulation and market surveillance, along with deep pools of liquidity in a centralized market, gives our market participants the confidence that they have come to expect as they rely on our markets to efficiently manage their risks. I look forward to addressing the questions that have been outlined by you, Commissioner Amalia, and appreciate the offering of these remarks.
Thank you very much, Brian. I'd like to recognize the chairman for any remarks he may have.
Thanks, Commissioner Amalia. Thanks, everyone, for being here today. Obviously, a lot of issues and questions that people have on their minds, including our staff and both Scott and I. But I have one question, and that is, have we created a fire hazard with all the interest in today's meeting?
If we don't get the air conditioning turned up higher, we will.
But looking forward to the rest of the day. Thanks a lot.
Before we go to Chuck Weiss, I do want to recognize, you mentioned staff. Joining us at the table today are our chief economist, Saeed Srinivasan, Vince McGonigal from Division of Markets Oversights, and our chief data officer, John Rogers. Obviously, the topics we're discussing today are squarely in their wheelhouse, and I'm pleased to have them joining us. And I've seen a number of staff here today that are also involved in oversight and issues as well, and I appreciate them joining us to take the opportunity to listen and follow this debate along. So, Chuck, if you could go ahead, please.
Thank you, Commissioner Amalia and Chairman Wiegand, for facilitating this discussion. I thought Brian did an excellent job of summarizing, I think, the strong points of our industry, and from an exchange perspective, we've talked a lot about over the years on these committee meetings about the risk controls, and I think a lot of the good things the exchanges do to try to maintain the integrity of its market. So I'm not going to rehash some of that from ICE. Like I said, I think Brian did a great job. So I'll come at it from a couple of other different commentary points. It was only 14 short years ago ICE was formed to provide an electronic venue for trading energy swaps globally. In OTC markets dominated at the time by phone broking and dealer-to-client business models, ICE was novel in promoting central limit order book execution and transmission of all market data to all market participants at the same time. Customers chose among a variety of connectivity options, including dedicated point-to-point lines, managed networks, or the public internet to suit their own cost and performance needs. Direct market access participants utilized our API to make prices and fulfill market-making obligations. As you can see, many of the issues to be discussed today are by no means new, but perhaps more confusing to understand and more challenging to manage in a market measured in microseconds. Though ICE has built and bought numerous exchanges since 2000, we've never wavered from our core objectives of transparency, efficiency, liquidity, and fairness. Which leads me to my second point. Our company, as you know, merged with the New York Stock Exchange 6 months ago, and so my colleagues, myself to some extent, but more my colleagues, are knee-deep in the equity markets and the issues there and reform. And our CEO, Jeff Sprecher, has been very vocal on a lot of the issues that were brought out in the book as practices that evolved over time and really need to change. And I think there are several of these that really illustrate the marked differences between the derivatives markets and the equity markets. So I want to just hit on those briefly. I'm sure others will today as well. First of all, you can't help but notice the extreme fragmentation in the stock markets. There are 13 exchanges for executing the very same stocks, over 50 different total execution venues, most of them off exchange, largely lightly regulated or unregulated dark pools with prices published only after transaction occurs. If you look at an analog in the futures markets, all futures transactions, have to be executed on exchange unless they meet various block minimum requirements or other EFS or EFP requirements. Also in the equity markets, retail brokers of U.S. equities typically sell their customer order flow to competing HFT firms. So there's no analog for this. Again, we have much less retail participation in the derivatives markets, but the participation that we do have is routed directly to the exchanges. And then lastly, the pricing structures, maker-taker pricing, which is the dominant pricing structure in the equity markets that Jeff's talked quite a bit about. Our belief is that has led to a lot of the problems that we have, and as pointed out in the book, people seeking to capture the rebate as opposed to paying the fee, and as a result, a proliferation of order types by the exchanges, extremely complicated order types that effectively have conditional logic built into them so that the user of that order can either maximize his chances of capturing the rebate or minimize the chances of paying. As a result, I think you end up with markets that no one's really happy with, and I think there's, those things will get addressed and improved. For ICE, we don't have maker-taker pricing. We don't pay people to trade. Our market-making programs consist of various discounts, caps, pretty plain vanilla stuff. We don't have jump balls for equity, things like that. And so all of this is markedly different from what goes on in the equity markets. I think the thing that is the same in both markets is they both obey the laws of physics. And so independent of all of those other issues, there will always be a value to speed and a function of how fast you can access the exchange is a function of what investment you want to make in connectivity, your PC, your firewall, a million different things. And customers have shown that they're not all the same, and they make choices along that spectrum, and microsecond latency are important to some and they're irrelevant to others. And I think it's important to keep that in mind. Now, that's part of the challenge. I think, once we get past today, hopefully the differences in these markets, and we scrutinize the derivatives markets, and we come away as confident as we've ever been, that we feel good about what's going on in those markets. Technology continues to advance forward. You can't really put the toothpaste back in the tube. So I think I look forward to today's discussion, and I think there'll be, you know, some good ideas and suggestions coming out of this about how we as exchanges can continue to maintain a level playing field going forward. Thanks.
Thank you very much, and the perspective on equities. I'm going to go to Rob Creamer with Geneva Trading, but representing the FIA's Principal Traders Group here today.
So I'm Rob Creamer. I'm CEO of Geneva Trading and chairman of the FIA Principal Traders Group. I'm grateful for the invitation to be here today and speak to you on behalf of the FIA PTG. The FIA PTG is comprised of firms that trade their own capital on exchange-traded markets. Our members engage in manual, automated, and hybrid methods of trading and are active in a variety of asset classes such as foreign exchange, commodities, fixed income, and equities. We are a critical source of liquidity in the exchange-traded markets, allowing those who use these markets to efficiently manage their business risks. The FIA PTG does not believe that a clear distinction can be made between high-frequency trading and automated trading. In fact, high-frequency trading, however defined, is a subset of automated trading and should not be used interchangeably with the term automated trading or as a way of arbitrarily identifying a type of market participant. The FIA PTG, and the FIA European Principal Traders Association have been in the forefront of efforts to strengthen risk controls and system safeguards across the futures industry by identifying best practices with respect to risk controls that reduce the risk of market disruptions due to unauthorized access, software changes, system failures, and order entry errors. The FIA PTG believes that automated trading technology has provided many benefits to the overwhelming majority of future market participants. More quality metrics have improved across the board as trading has become more automated and more competitive. Trading costs are lower, markets are deeper, more liquid, discrepancies in prices across related markets are reduced, and prices better reflect information about the value of commodities underlying futures contracts. The FIA PTG therefore believes that any regulatory effort to improve market infrastructure must at a minimum preserve the market quality improvements that have occurred as markets have become more automated and more competitive. If the CFTC determines that further regulation in this area is warranted, this determination should be supported by solid empirical evidence and rigorous economic analysis. The FIA PTG also believes that access to the market has never been fairer or more attainable. Access to the futures markets no longer require you to stand in a trading pit and fight for a good seat at the table. It no longer requires membership, a family legacy, or residence in the location of a trading floor. The need for physical proximity to exchanges has been eliminated with colocation services, which are widely available to all market participants. Exchange and third-party offerings are widely available and easy to analyze. Materials are published on the websites of most exchanges, which list the available services, cost, and additional resources to help one through the process. Colocation has leveled the playing field for firms whose strategies demand the fastest access to market data and trade execution. While it is true that firms compete with each other on speed, from a technology perspective, the location of a firm no longer affects a firm's ability to remain competitive. For the vast majority of market participants, colocation is neither a source of advantage nor disadvantage and is not relevant for many participants in the markets. Central to the market structure discussion has been the issue of fragmented versus centralized markets. In the equity markets, the threat of monopoly was traded for hypercomplexity. While this trade-off was effective at reducing cost, fragmentation in the equity markets created many additional challenges that have been largely avoided in the futures markets. The vertical silo model works well because of its simplicity, which improves the ability to manage risk, it reduces points of failure, it centralizes data, and maintains a level playing field. In addition to the inherent simplicity of the vertical silo model, the futures exchanges have made attempts to reduce the complexity and enhance the reliability of their platforms. Relative to equity markets, there are very few order types in futures markets, and exchanges publish transparent descriptions of their matching processes. A recent article has called into question the fairness of market-making programs. Exchanges have a long history of innovation, and the development of new markets is critical to meet the demands of the complex world in which we live. The research and development conducted by exchanges and product specialists will be fruitless without the service of market-making firms that shoulder the risk of supporting the launch of new products. Some firms have the capability and risk tolerance to support the launch of new products, while others have the ability to provide additional liquidity in more mature markets to reduce costs for end users. There is a healthy symbiotic relationship between market-making firms and exchanges. It is our belief that exchanges should be allowed to use their discretion in the design of the programs in order to improve market quality and support innovation. The details of programs and eligibility requirements should be made available. The application process should be clear, the requisite qualifications should be specified, and the vetting of firms should follow a structured process. This should be conducted by exchanges with full transparency provided to the Commission while protecting the anonymity of the firms that have been vetted and ultimately enlisted. It is my understanding that this largely reflects the process today and that the Commission is aware of such arrangements. In conclusion, the FIA-PTG believes that the futures markets are fair, have largely avoided the complexity faced in equity markets, and we support transparency and fair competition and the Commission's efforts to ensure that this is the case. We appreciate the opportunity to be here today and hope that our comments will provide value to this committee.
Thank you, Rob. Next, we'll hear from Joe Saluzzi, and then after that, it's going to be open discussion about anything our panelists have said and open questions. Everybody knows the routine. Put the cards up. I am having a hard time seeing down that end of the table, so if I don't see your card, make sure you wave it. So, Joe, wrap us up for the witnesses, please.
Thanks, Scott. Thanks, Commissioner O'Malley. Thanks, CFTC, for having me here. I do feel like a fish out of water. I'm an equities trader, so sorry about that, folks. But I'm going to give you, I guess, an equities perspective. What I've heard so far is, the futures market's great, equity market is bad, and, I'm not a futures market guy. I'm not going to comment there, but I will comment on the problems that exist in the equities market, and hopefully they don't transpose over to your markets. Themis Trading is an institutional equities broker. We trade solely on an agency basis for our institutional clients, which include mutual and hedge funds. In addition to trading, we focused a lot of our attention on equity market microstructure issues over the past few years. We wrote a book in 2012 called Broker Markets, and if you want to know anything about us, just read the book. While some have called us HFT critics, we prefer to be thought of as market structure critics. Years of regulations have helped create a fragmented equity market that currently is the focus of much debate. This fragmentation has led to the creation of time and price arbitrages that many HFT strategies seek to exploit. While we're not sure if any of these practices are illegal, it is clear to us that securities regulators lack the surveillance methods required to police this high-speed, low-latency stock market. Their recently adopted surveillance system, MIDAS, falls woefully short of what is needed. The SEC has essentially admitted this deficiency by proposing the Consolidated Audit Trail, otherwise known as CAT, which is still years away from being built. Essentially, securities regulators have come to a gunfight armed with a very dull knife. While we acknowledge that HFT is hard to define, it is clear that many HFT strategies employ cross-asset strategies, including trading options, currencies, bonds, and futures. This new breed of high-speed cross-asset trading has stretched the boundaries of traditional regulation. While the SEC struggles with their own workload and budget constraints, it appears that the CFTC faces some similar issues. In his statement of dissent of the 2015 budget, Commissioner O'Malley stated, while slightly more measured than the November request, this budget request perpetrates the futile strategy of hiring more staff to oversee a vastly complex, high-speed, and technology-driven market. This lack of mission priorities makes these wide-ranging budget requests seem somewhat random and ill-defined, only because they are. I'll leave that to you, Commissioner. Recently, the book Flash Boys, as we've discussed already, brought this secretive and complex subject of high-frequency trading to the public. While some may dispute some of the book's facts, there's no question that the book successfully achieved what we and many others have been trying to do for the past few years, have an open debate about our market structure. We've heard numerous calls for top-down or so-called holistic reviews of our market structure. We submit that this would be neither productive nor effective. Correcting the systematic unfairness in the market structure can be done simply and without disenfranchising any key market participants. The best solutions to complexity are usually simple ones. We have three that we believe that can change the equity markets for the better. Number one, eliminate payment for order flow, whereby brokers sell their orders to a trading firm along with the maker-taker policy, whereby exchanges provide rebates to traders for posting liquidity. There's nothing unprecedented in either of these suggestions, and markets can readily adjust and adapt. Rebates are polluting the trading ecosystem and unnecessary incentives and need to be done away with. Number two, mandate complete disclosure of dark pool and smart order routing practices. Without knowing how orders are routed and how dark pool policies factor in, it's hard to determine whether or not they contribute to or detract from the market's well-being, and designating an objective as a means of allocating capital. Number three, regulate the data feeds. Trading information should not be fair game to be made available by the exchange to the highest bidder. Exchanges should grant investors the right to opt out of having their data sold to trading firms, which can then track and act in advance on information. There's no longer any reason to continue to create exploitable opportunities from unintended consequences. What's needed are straightforward solutions to fix current problems that provide exploitive opportunities and impair market liquidity. Our markets need simple, straightforward solutions that provide fairness, that can easily eliminate inefficiencies and complexity that hobble their fundamental purpose. Thank you for allowing me to comment. I look forward to the remaining discussion.
Thank you very much. Larry Tabb, first tab up.
Thank you, Commissioner. I'd like a little clarification, Joe, on your idea of opting out of the market data feeds.
I think Larry's asking me, what about opting out of data feeds that I just mentioned? One of the issues that we have with data feeds, particularly in the equities market, which is all of my comments, by the way, obviously are equities market related. Data feeds are not only fast. Well, we all know they're fast, and we all read the book about how the latency and the 350 microseconds and the Lincoln Tunnel and all that stuff, right? We get that. They also contain a lot of content, okay? Content is king as well as speed, okay? Content from an institutional investor's perspective is extremely critical. I would like only the information that's visible on the consolidated tape to be shown in these data feeds. In other words, why would my order that's just gotten canceled need to be shown? Why would a revision need to be shown in the data feed? A couple of years back, we wrote a paper called Data Theft on Wall Street. I guess a lot of you guys don't like the topic. But the bottom line was we found that the two exchanges in particular were giving out hidden order information. There was a flag attached to each one of these orders, and that flag basically allowed someone reading the data feed to re-engineer the fact that there was a hidden buyer. Well, after our paper went out there, it took a couple of weeks, actually kind of stalled in the US, but in Europe they got a hold of it, and lo and behold, a few weeks later, these practices were fixed. My point is, as an institutional investor, I don't want the exchange to have that ability to sell that information. It's my information. It's my client's information. So, but you do need, obviously, the basics of what, obviously, price, time, and so on. But we think limiting that and allowing the institutional investor to at least opt out of that is a good suggestion.
So what kind of information are we talking about? So they're not doing the hidden order information anymore. So you wanted them to opt out of providing cancels and
we don't know exactly.
And rebooks?
Well, there's a good point there, Larry. I don't think there's been much work done on data feeds and content, and we would actually like to see a study as to what's in some of these data feeds. They're very cryptic. Obviously, they're all available online, and you can see, the NASDAQ itch and so on. We would like the basics of information. So why would you need to know when my revision took place, when that order that's sitting on the book, which you can't see with the visible eye, has now been revised? You're giving out more information that the user didn't ask to be given out.
Is there any way that cuts both ways, that more data, a lot of our rulemaking has been to disclose more, right? Publish more, disclose more. How does that, I could see where an argument could be made that it cuts both ways, that too little information isn't informative of what's in the market, and your point being that
right, the basics still need to be there. Absolutely, when a trade takes place, we see it on a consolidated tape. When there's a quote being put on there, we should all see that. But I guess it's the personal information that's being given out about that particular order that needs to be, there's a linkage there between the order and the trade books that needs to be adjusted, or addressed, rather.
Can I get maybe somebody to comment from either CME or ICE, maybe Julie or anybody that what is the content of the futures market? And are the concerns that Joe raised similar to what we have in our market? When you mentioned, Brian, that we have one single data feed and it goes out.
We send out an aggregated feed of the price and quantity that comes out, bids and offers. That's it.
Nothing, none of the cancels or some of the things that Joe raised?
We don't do it by the order. We don't provide all of that information. That's correct.
I have a question. So the exchanges do sell tick-by-tick data, right? From what we understand. So tick-by-tick data, as we understand, is every message, an order submission, modification, cancellation. That's something that, especially I think some firms can acquire from the exchange. You get it on a real-time basis.
We provide tick-for-tick data. That's price changes.
Just a question. I'm just curious. One of the hallmarks that has been highlighted about the futures market that sort of protects it is the lack of fragmentation. I'm curious, Brian and Chuck in particular, your views on the introduction of CEFs and the perhaps the introduction of MTFs into the regime. Does that create an opportunity for fragmentation that will bring some of the issues of that we discussed about in the equities markets to the futures and swaps markets?
I think it's certainly possible. We haven't talked about it really in rulemaking for CEFs, and now the CEFs are out there. There's been no talk of any kind of national best bidder offer system. You know, with RFQ of one and dealer to client model still alive and well, I don't know that, you know, it may be that it doesn't get to that point. That's a topic for the third session, I suppose. But I think if there is success in seeing more central limit order book trading on CEFs, then yes, that's something that's presumably going to have to be addressed. But if you think about, you know, one thing you have to put in perspective with the HFTs, I mean, we have hundreds of futures contracts. We have HFTs in probably 20. It's a very liquid market type of trading. I mean, they help make it liquid, and they can only participate because it can get to that level of liquidity. I don't know if interest rate swap. I'm not an interest rate swap expert. You know, does that market get to a point that you have the kind of HFT activity where the interaction of the different CEFs and different resting bids and offers, you know, rises to the problem of people are racing from one CEF to another, you know, as described in the book. More questions there than answers, but that's.
Thank you, Commissioner. So most folks might notice I write furiously, but that's just to keep my attention. Listening to just the past 50 minutes, going through pre-trade, transparency, ATS, HFT, should they be defined, registration, I don't know. Content of trading activity during the day, what are we doing with messages? Should message information, tick data, how that information should be available to market participants. Colocation, do we have it? Does it work? Should we do something else? Market maker incentive program. So each one of those topics seems like we could spend an awful lot of time digging down. We did the concept release, I get that. A lot of discussion, 9 out of 11 on HFT. And so I think sitting here about the case for change and these discussions that we have surrounding, you know, are we circling the wagons with respect to trading activity in derivatives markets because folks are saying we do such a good job as compared to the equity markets, and what lessons can be learned from that activity. So where's the case for change? Where should the Commission interact with the market on mandating certain pre-trade risk controls, whether we should impose some registration regime, what benefit do we see for that registration regime? Should we be asking the Commission to consider making available, the exchanges making more information available about the types of trading? On colocation, should we be asking, and I'm just putting all these questions out and then I'll be quiet, For colocation, should we be interested in seeing latency? What's the publication of the latency for the different uses, the different access to the various futures markets? How does that compare by exchanges? Should we require that all exchanges, separate from impartial access, establish a colocation facility rather than doing it on exchange? And then that's particularly this market maker incentive programs. I was interested in the comment about, all right, we'll start up for new markets and then maybe market maker for mature markets. Does that work when the markets are highly liquid? And what do we do with these rebate programs? How transparent should we require the exchanges to be about the types of participants that are actually reaping benefits? The amount of proceeds that are being paid as part of these market maker incentive programs. So these are the types of questions that I'm hearing going through the course of the presentation. Where is the case for change for the Division of Market Oversight? Where is it meaningful for us to come in with an opinion?
Chris Lorenzen, Eagle 7. Both Brian Durkin and Chuck Weiss earlier made statements referring to the fact that futures markets are very different from the equity markets. I think it's extremely important to point out some of the main differences between the two. Futures markets have a single transparent point of execution, whereas the equity markets, trading takes place on numerous exchanges, dark pools, and ECNs. Futures exchanges offer limited common order types. In the equity markets, one will find numerous and unique order types being used. Pricing. On the futures exchanges, all prices are visible and executable by all participants. This differs in the equity markets, where not all prices are transparent due to such things as sub-penny pricing and dark pools. Common practices in the equity markets, such as payment for order flow and internalization of orders, are not prevalent and part of the market structure in the futures markets. These important points help lay out the differences between complexity and simplicity when analyzing equities versus futures markets.
Thank you, Mr. Chairman. Joel Hasbrook from New York University. I want to connect a couple of dots here because the themes sometimes arise with different words and terminology. So I was struck by Mr. Durkin's presentation stressing the equality of the way orders were treated and handled in the Globex matching engine. I was also struck by Rob Creamer's subsequent point that market-making firms are entitled to the advantages that they enjoy. Now, you can't have market maker subsidies and all orders being treated equally. I'm not arguing one way or the other, but there are trade-offs. And the third dot is Mr. Saluzzi's point about disclosure and maker-taker fees. Maker-taker fees are, after all, also another form of market maker subsidies. And the same principles that make market subsidies good on the futures markets might also make them good in equities markets. My last point is that with respect to selective disclosure, to argue that there should be more disclosure for dark pools and simultaneously allowing individual traders to opt out of reporting certain information about their trades is, I'd be curious as to what principles we should allow there to justify the difference. But I think one thing that we could agree on would be that informational asymmetries are bad. You're giving somebody inside information, so whatever information is getting disclosed should be disclosed to all people as equally as possible. Thank you.
Thank you. Brian, you want to respond to that?
Well, I would invite you to spend some time with the CME group so that we could give you a more in-depth understanding of our market model and our market structure. So I offer that out to you because I think you were confusing a few terms that were discussed here today with respect to orders being treated equally. I assure you, sir, all orders are treated equally in our system and in our matching engine. When an order comes in, it goes immediately into the system. If it's at the current bid or the offer, it is matched appropriately and according to very transparent algorithms that are very well described on our website. In terms of market maker programs and incentive type programs, you have to be very careful not to confuse the differences between what occurs in the equity markets and what occurs in the futures markets. Very careful distinction between the two of those. In the development of incentive programs or those types of programs in the futures markets have always been based on developing liquidity in new products and evolving markets. So it's bringing market participants into a system to help them build a marketplace and help develop liquidity in a marketplace. There's very transparent criteria that participants in those programs must adhere to. The programs themselves are posted on our website. They're filed with the Commission for approval. There's prescribed criteria that people need to meet, but the fundamental premise is to develop and build markets and build liquidity. That has nothing to do with how the orders, when they come into the system, are treated by the platform.
Brian, I believe CME has 9 separate order types.
7.
7. Similar on ICE?
Similar, yes.
And
single digit.
okay, and on the equities, do you have a sense?
Let's just say well over 50.
Okay.
I would guess 100. I don't know. I'm guessing, but I know there's more than 50. And we've New York Stock Exchange, again, in trying to take a first step. On our last earnings call, Jeff announced that we're trying to scale those back. Some things we can do unilaterally. Other things have to be more of an industry or the SEC saying that it needs to be done. But we're at least retiring 15 order types. So it's a very small step, but it's a step in the right direction, I think, to try to get back to, I think, what Joe said, simplification is part of the answer here.
Yes. Hi, this is Irene Aldridge from Able Alpha Trading. I think that what we've learned last meeting, during the last meeting, that it's very difficult to agree on philosophies of trading versus manual is better than automated, et cetera. But however, we can all agree on a few basic principles, that is, that market manipulation is bad in whatever form, and that crashes and other market disruptions are bad. And to Mr. McGonagall's comment, I think the key thing that I'm very excited to see on the second part of today that the Commission is already focusing and we should spend more attention on is really market surveillance. And if we have strong market surveillance that can detect a sort of activity, all kind of undesirable activity, and potentially detect runaway algorithms and predict risk events, market disruptions, and even track high-frequency trading given the currently available information. And there is a lot of new research that has come out in the last year that allows us to do that. I think everybody will feel that there's more confidence in the markets, and it's scientific approach that creates more transparency. Is everybody will be more confident in what is going on. And obviously there are some issues with surveillance that I guess going to be discussed in the second part, such as whether pre-trade is optimal, or runtime is optimal, or post-trade is optimal, and there some time sensitivities to various of these issues. But the bottom line is, I think the Commission is on the right track, and it's the surveillance that's really going to unite, if you will, different parties, and further strengthen the confidence that the markets are really functioning the way they should. Thank you.
I'm going to call on Cliff, then I'm going to go to Mr. Lothian, Kincannon, and then Keith Fish.
Three points. First point, just I think it's worth remembering that one of the big changes in the futures industry is when the exchange clearinghouse verticals became public companies, for-profit public companies, and were no longer controlled by their members. Fundamentally changed the landscape in terms of incentives. Now, Chuck and Brian's colleagues have a fiduciary responsibility to their shareholders to maximize revenue and no longer provide, let's say, special privileges to certain market participants. They would be subject to the plaintiff's bar, who was always enthusiastic about bringing suits against public companies for not maintaining their primary responsibility, which is maximizing shareholder value. That was not the case previously, nor does it exactly fit, even though many of these are private companies. Many of the exchanges, so-called, in the equity market are actually owned by market makers. It's quite a different market structure between the two. That's pretty fundamental difference. Second point is, and I've said this before, but I just want to make very clear, the co-location problem that people talk about is very simple. It's the co-location of a sensible market structure, as is the case with derivatives, with an insane market structure that was designed by GS14 lawyers in the securities market. And the major takeaway for the commission should be, you guys have it right, they have it wrong, they should change, you don't have to change. And in fact, I would say, as my final point, that the biggest threat to the market, and this is particularly prevalent given that we're talking in a very low volatility, frankly, low interest rate environment, low inflation environment, which is not going to last. It may go on for years. I'm not making any bets. But I think we need to all be thinking about what the next crisis is. And the next crisis, I think, is actually being promoted by the Commission, which is abandoning its traditional approach of principles-based regulation for SEC-style prescriptive regulation, by which the way those GS14 lawyers created the problem was they didn't know anything about markets. They didn't think like economists. They thought like lawyers, which the principle is to employ more lawyers, right? Not increase liquidity. The question I think that the Commission needs to worry about is not that the HFT guys are too powerful. On the contrary, I think it's almost the opposite problem, which is where is liquidity coming from in the future that helps stabilize markets? Where does the speculative interest come from in the future when markets go volatile in the face of hugely increased costs being imposed on those market participants? I think that's the scary thing, is that there'll be insufficient HFT to handle the requirements of a more volatile interest rate environment. So that's the threat that I think we ought to worry about in the derivatives market.
I wanted to ask Mr. Saluzzi about his point number one about eliminating payment for order flow. It has been suggested to me that you can't ever eliminate payment for order flow, that it's a little bit like outlawing prostitution. You can make it against the law, but you can't eliminate it. Historically speaking, there's the payment for order flow that you would see on the books, and then there's also incentives that are offered to those decision makers who are the ones that are directing that order flow. You know, to say that there's not payment for order flow in the futures markets is correct in an electronic market, but historically speaking, if you were ever around the trading floor at Christmas time, you would know that brokers rewarded trading desks and clerks and runners very handsomely for the order flow that they directed them. The difference being is that the brokers were executing those orders. They were brokering, filling those contracts. They weren't on the execution side of receiving the benefits of the trade. And in terms of you know, you mentioned futures markets good, equity markets bad. Okay, yeah. But you know, historically speaking, there's been a bias in the markets that, you know, if you go back to when I came in the markets in the specialist market, the things that they did on the New York Stock Exchange with that model if you did that in the futures market, would land you in jail. Okay, and so there's some very historical kind of differences and biases that I think have delineated those two markets and made practices different. There are some of the same incentives. We all want the order flow to come to us, but I'd like to ask you, how do you think you police it when it's just going to go underground?
Well, I mean, it's a question for the regulators, obviously, and how can they police it? And I think John brings up a point about the 90s, and we all know the pictures of the specialists getting carted off in handcuffs. Well, that was a problem of regulation. Okay, they're going to take advantage. People are going to do what they can do as long as no one's looking, right? So I think just like we had then, we have the similar problem now, except that the floor has now been transferred to server farms, right? And now it's harder to even spot where this maybe potential problems are. But when it comes to payment for order flow, there's certainly two that we focus on. The maker taker is a no-brainer in our opinion. Get rid of it. The exchanges are paying for order flow but I don't want to take away the exchange profit because they need to make money, right? We get that. So if on average it's a 10 mil spread, let's just call it 10 mils to make, 10 mils to take. I'm more than happy to pay them, right? That should be their fee for putting those buyers and sellers together, as opposed to now where a rebate could be maybe 35 mils if you're a high-end client, and the take fee is maybe 28 mils. Well, let's just flatten this thing out and call it what it is. Okay, so there you don't have that incentive anymore to go to. What happens, obviously, is the broker routers are going to certain spots, or at least they were, and maybe they still are. We're still not sure on that, depending on where the payments were highest, right? So if you get rid of one, maker-taker, you're getting rid of some of the problems. But two, the payment for order flow where brokers are selling it to market makers is a big issue that no one seems to want to talk about. It was addressed in Michael's book, but that's where we think price discovery is getting distorted. And just as an easy example, let's just say you're in your own retail account and you're bidding 10 cents for 500 shares and you want to buy the stock. Well, someone wants to sell you that 500 shares. He hits the button, sells it to you, but instead you get nothing and they get it at 10.0001, and that's considered price improvement for the seller. Well, what's not talked about is what about the disadvantage of that buyer who was sitting there wanting to buy stock and basically got disenfranchised and stepped ahead of by that internalizing broker. Well, what most likely happens is then the order flow is modeled, we all know how this works, and possibly that buyer ends up paying 12 cents or 15 cents. So who got hurt? Did the sub-penny price improvement mean anything to that seller of 500 shares? Or did the buyer now, who has to go pay up, really get hurt? So when we talk about off-exchange volume, and a lot of people toss the 40% number around, part of that is dark pools, but a good chunk of that is these internalization market makers. So for us to get a true price discovery, get rid of all of these payments, have the buyers and sellers meet, you may widen spreads a bit. Okay, it may happen, it may not, but we don't know. So that's why we do applaud the SEC at this point for looking into pilot programs. Those are necessary. You want to do these steps. You don't want to do it right away like we do at Reg NMS and we just roll the thing out. Maybe there's a pilot program. They're talking about the wide tick pilot program now, right? That's a good idea. Let's bucket them into two different ways. Does it make sense? Let's have a maker-taker elimination pilot program. Let's start to look at these things, but let's not wait any longer. We've been talking about this for years. 2007 was Reg NMS. What year is it now, right? How long is this going to continue?
Chris Kincannon.
Thanks, Commissioner. I thought I would try and respond to Vince's question around what action could the Commission take. I mean, I do appreciate coming to the CFTC and learning so much about the equity markets. It's been very helpful and illuminating. Apparently, the equity market is bad. Futures market is good. We can all go home. And Cliff, for the record, I was a GS-13 and had something to do with that market structure you complained about. First, in terms of risk controls, I think that's one area where the Commission has an opportunity to take action that is actually protective. We have the exchanges in the futures world that has in fact provided exceptional risk controls, exceptional behavioral controls, but with respect to an individual firm that has connectivity to an exchange in the futures world, the exchange doesn't have the full picture of that firm's risk. Only the firm has the full picture of that firm's risk. Only the firm knows the full picture of its behavior, the behavior that's appropriate for that firm. And so we can rely on the exchanges today. I don't think there's this looming risk out there. But I do think that each individual firm can define its true risk controls, and those risk controls can be overseen by the exchanges, by the regulators, or even by the CFTC. So in the terms of risk controls, if there is a firm connecting directly, whether through colo or a physical connection to the exchange, it should have appropriate controls before the orders pass into the exchange environment. These are firms that have computers. They are trading with computers. We have that nowadays. And I just think that that's one simple step that the Commission can act on to add further protection. And when I talk about risk controls, I'm talking about not only credit risk controls, but behavioral risk controls, sending too many orders, sending too many messages. That's defined by what's unique to that firm, and it should be something that's the responsibility of the firm if they choose to connect directly to the exchange. If they want to go through an FCM or another intermediary, that member would then have those risk controls obligation. And this is a model that has been adopted in Europe in cash equities by ESMA. It's been adopted in Australia, Canada, and yes, on the equity side, by some GS14 lawyers, actually wrote some risk controls rules. So there's models that the CFTC can look at and be informed by. They don't need to be prescriptive. They can define several minimum levels of control, and it's a fairly simple principle-based rule, to Cliff's point. I just have one more question. Joe, you had mentioned in your point about the surveillance of the U.S. equities market that you had some concerns around flaws around that system, and I agree with you that there are some improvements that should be made, and the consolidated audit trail is coming, taking a while. But I want to understand exactly what is the flaw. You have folks here from FINRA that largely surveil all of U.S. equities. Options are surveilled, and data is shared from futures to equities. I'm trying to understand what is the flaw in the U.S. equity surveillance system that you're so concerned about.
Sure, I appreciate that, and I think the current system, Midas, which was obviously built by an HFT firm, is a system which tracks.
I'm sorry, I'm not talking about Midas.
Okay.
I'm talking about FINRA, which surveils the U.S. equity market.
Right. We currently have OATS, which is a good spot, right? You're getting there, and I think the consolidated audit trail.
No, it's not OATS. It's FINRA runs a surveillance system that takes the full depth of book and surveils the full depth of book, separate from OATS.
I think what we're looking for is more in the way of routing, where the orders are being routed, at what point they're going through, are they being, what the consolidated audit trail is trying to do, okay? But from a user level would be nice as well. And I think the one fault of the consolidated audit trail, if it ever does get built, would be that it doesn't go down to the user level. It's going to be down to the market maker ID. So in other words, if I was a sponsoring market maker and I had 30 firms underneath my umbrella, I think it's going to be pretty difficult to identify the actual user who may be using some, let's just say, nefarious behavior. Let's just say there's some spoofing going on. Will I be able to tell? I don't know. We want to drill it down to the actual user. Why not? It doesn't seem like anybody, and I think one of the criticisms there was from some folks saying, well, if the regulator had that level of detail on my activity, he could then maybe leave the regulator and go to a private firm and then know what I was doing. And I think that's a ridiculous argument. I mean, that's an absolutely ridiculous argument. So you need to drill down to the actual user. You need to figure out if there is spoofing or banging the clothes or whatever these things are that are actually going on out there. I think it's not much to ask.
Can I want to get a response to your other question. You were talking about direct market access, and this is actually a futures term, and this was a question that we asked in the questions to all the commission, to all the TAC members, and so I'd like to have either Chuck or Brian or both to touch on, what are the exchange policies and procedures for direct market access, what risk controls are in place today, and are they the same for all participants, or do they differ by self-clearing members and clients? And should there be a minimum standard, as Chris raised, or a registration required for direct market participants? If we could kind of tick some of those off, that would address some of the things on our list.
First of all, as an exchange, we support clearing members allowing for direct market access, and we hold any participant, including those that have direct market access to our platforms, accountable and are required to adhere to our credit control requirements. So, we have pre and post-trade credit controls that, have been adopted by CME Group, and we require every single one of our clearing firms to abide by those controls. There is a customer acknowledgement agreement that is signed, and it must be signed and authored by both the participant that's having the access as well as the clearing firm. And they ascribe to and commit to ensuring and validating that all of those credit controls that we require are in place and adhered to. We also require the direct market participant themselves to subscribe to conformance testing. So they don't come into our system blindly in any way, shape, or form. They adhere to those same criteria and principles that we hold all of our market participants to. Ultimately, the clearing firm is financially liable for anything that occurs or misstep, and that's part of the overall authorization to allow that type of access to come into our system. In terms of registration, we have that granular level of registration. So I can tell you, I know every single participant that's bringing every single order message into our system every single day, all day. Down to that granular level. So we also have a criteria that requires, under our tag 1028, an identifier to see whether or not a message has come in through manual or automated means. So we know the individual participant. We also know the style and the way in which the order came into the system. And we have every single message that comes into our system every single day. And that information feeds itself into a surveillance system. Just have to mention about the consolidated audit trail. So I'm sorry to be a little bit redundant, but in these markets, we have 100% of the activity that comes into our markets every day. That information is used to feed very meticulously designed surveillance systems. For example, what occurred on May 6th, we were able to have a full accounting of what occurred in those markets to the CFTC. I think it was 11:30, maybe midnight by that evening, but we were able to give you a full accounting of the activity that occurred in these markets, message by message.
Brad, I'm just curious, you don't have to get into all the detail, but in surveilling the risk controls of the firms that have direct market access, how often do you look at compliance with what they've agreed to along with the clearing member? Like just generally speaking, what kind of program do you have in place?
Through our audits team, it's incorporated in terms of their financial risk audits. I don't know the exact rotation, but I believe that they're hit every year in the context of validating the risk protocols and the risk procedures of the clearing firm and those that are clearing through them.
I mean, I don't have a lot to add to that. I mean, our processes and procedures are largely identical. I think we don't have any situations where we're investigating something or somebody's complained about something in a market and we're at a loss for data. We don't know exactly who it is. We don't have granular enough information to figure out what is going on. We just don't have anything like that. It's not a problem.
So we put forward our testing and supervision document, a concept release. We talked about direct market access. We talked about controls in place. I would assume, and it's clear from the document, that ICE and CME do not have identical kind of risk management tools. You have similar, but not identical. So if the commission is thinking about establishing or federalizing controls that you already have in place, and how do we think about enabling both sets of controls without trying to overreach and create a one-size-fits-all solution? What advice do you have for the commission?
I think Cliff or someone mentioned it earlier, remain as principles-based as possible. I think getting prescriptive on this is a bad idea. And what we're doing today, I suspect we'll be doing something differently tomorrow. We will continue to try to improve. We're layering more and more both pre and post-trade risk controls. I mean, Brian and I are cordial. We compete fiercely in this marketplace, and we watch what each other's doing, and we watch what the market-making programs each one has, and we're probably each other's best policemen about what is going on. I think it also spurs us both to improve what we're doing, and particularly on the technology side. So I would urge you, please do not get prescriptive, whether it's risk controls or something else we've talked about in these meetings. Matching engines, discrete auctions. Should it be a continuous market, or should it be maybe? I don't know. I mean, there are a lot of, there are very liquid futures markets and they're very illiquid. And what works in one doesn't necessarily work in others. And I think, if you leave the exchanges there under your regulation and full transparency of what we're doing to improve whatever problem there may be, I think ideally that's the best approach, as opposed to trying to get in a room, write down on paper what the ideal optimal solution would be in a vacuum, and then hope that when you implement it in the real world, it actually works the same way.
Just one comment, Commissioner. It's your work and this team's work over the last few years. When you take a look at the controls that we've articulated today, yes, there's a number of these that we've had in place for a period of time. There's been some that have evolved as a result of the work and the effort of the group around this table. So that's, a testament to the futures markets and our ability to evolve and continue to adapt and innovate as these markets continue to innovate.
I would point out this was the very first meeting we had was on risk controls, and Michael Gorham ended up bringing together a consensus document on what the commission should do 4 years ago now. So I'm going to, Chairman.
Can I ask the same question of you, Chuck? Just if you're ensuring for compliance with whatever risk controls those who have direct market access have in the exchange, what do you do, generally speaking? Like, how do you monitor that?
I think, as Chris pointed out, there is a limit to what we can do. I mean, we don't go into their office and ask them to demonstrate behavioral checks over, what are too many messages, or what are you doing in this market relative to ours. We have, when they initially come into our markets, they have to pass a battery of conformance tests. When we have major upgrades to the system, software releases, they have to repass those conformance tests. And the pre-trade risk controls that are administered, there are, single order size limits, net long short by product, absolute long short by product. So, all the different options, very different risk limit sets for options. So as many different kind of controls that we can put around that. And it's important to note that those controls are the clearing members' controls. The clearing members set those for the HFT. So the HFT is not setting those for themselves. Maybe that's stating the obvious, but it's important to note that. So we really, it's ultimately the clearing members' responsibility that they're taking that risk in clearing that firm. We're providing exchange level controls and then largely relying on the clearing firm's relationship with the HFT, because the clearing firm and the firm level should both have their own controls aside from the exchange level controls.
I have a question.
I'm going to, after Saeed makes a comment, I'm going to go Keith Fish, Walter Hamzer had his sign up, Larry Tabb after that, and Steve Joachim, and then Richard Gorlick, and then Brad Levy.
This is a question for Chuck. Brian was mentioning what we call the ATS flag, I guess, that's there in the data we get from CME. Curious to learn what are your plans. Is ICE planning to have market participants submit a similar flag?
Honestly, I can't tell you if we have that exact flag. I mean, we have an exhaustive authorized trader management system. I think we've done some presentations here before, and Tribune can speak to it on the next panel. But we have very detailed information on who's the firm financially responsible for this order, who is the individual that's working the order, or at least responsible for the computer that's working the order. So if we have to get in touch with somebody, so there's a, this isn't order by order, but this is set up for the ID on that order. We can map that back to our authorized trader management system, and we have all of that static information about who that person is. Whether order by order it's flagged as from an ATS or a human, I honestly don't know the answer to that. Tribune would have to answer that.
Keith?
Thank you, Commissioner. I'm Keith Fish from Trade Forecaster Global Markets, and I've served on the subcommittee for automated and high-frequency trading. I want to go back to something that Joel raised and then Chris commented on, and that's the issue of equal access. Equal access doesn't mean equal cost. And so trading cost, as Rob alluded to, might be you might be incented to help support a market, and those same incentives may not flow down to the retail guy trading from home, but equal access is a very important thing, and I think the exchanges do a very good job of making sure that the demand for access in all types, colocation otherwise, is satisfied by their ability to supply it. And that's something to, I'm sure they have to balance to their shareholders is how much excess capacity that they build out so that they can meet emerging demand. But the nature of access, is pretty important. And I think that if we look at the equity side where they developed the model of sponsored access, I would really hesitate to adopt a similar framework in the future side. I think that the intent of sponsored access was to move firms to a more controlled environment, but that basically reduced competition for providing liquid markets and created other frictions in that whole microstructure environment.
Keith, you want to touch on what those frictions are? Because, if we've got direct market access and sponsored access, when does it become too much?
Well, so if you model after the equity market and you go down the path of sponsored access, you're increasing the latency, essentially, of someone trying to provide liquid markets to those various exchanges. So a firm that might have been very well suited to provide markets if they were directly connected with the proper risk controls and proper vetting and proper conformance testing for those exchanges, has basically now been shut out of the market by having to route through another entity in order to do that. I'm sure that doesn't necessarily affect firms whose business model isn't to do that, but it changes the competition landscape in the equity side, and I would want you to very carefully look at it if you were going to do that on the future side. But going back to access issues, the features, choices, specifications, are very transparent. I hope they continue to be transparent for access. And I again repeat that regulatory initiatives or exchange initiatives for access issues should not create unevenness, or specifically should not create institutionalized unevenness between participants. There's another issue that came up in terms of timing differences, and I don't think that this was really talked about a lot, but the question is whether there are timing differences between order confirmations and how they're received between participants. And my understanding is that there really is an effort to get that information out to participants at near concurrency, if not at the exact same time. But the question comes up because there are differences in people's responses to that information, and I'd like to suggest that really there will always be differences, always be timing differences in how people process information and then act on it, and it's a systemic, I'll say systemic quality of the market, not a systemic problem. I think that issue.
On that point, why don't we just have Julie with CME, who's responsible for the Globex and making the changes in the latency between trade and confirmation, address this question directly.
Hi, Julie.
Thank you for asking that question. It's a great opportunity for, I think, us to really explain what I think a lot of people don't understand very well. And that is, there's a very big difference between, I think, what you hear in the media about different market data feeds, where certain individuals can pay for a proprietary feed that's faster than the consolidated feed, and a trade confirmation. And I want to kind of explain the two very, very quickly and move on. So I think for an average investor, whether you're sitting at home, whether you are a commercial investor and you're, co-located in a high-frequency shop, you're all looking for the same thing. And that is when you're sitting at your computer, you're looking to make sure that when you put an order in, you get some type of confirmation that it was filled, that it was acted on. So again, even the grandmother sitting in her home who's buying one share is still waiting to get that confirmation that says, yep, you were filled. That is a trade confirmation. That is the information that goes back directly to the individuals that were part of a trade. There is market data. That is a separate type of delivery of information. That information goes to the whole world. So when we talk about the fact that we have one market data feed, you're not able to buy or purchase a faster data feed, we're talking about our market data feed that goes to the whole world. We provide it in one way. You can choose to receive it in multiple ways. All very transparent, but we push it out our door in the same exact way, and we don't offer different types of services based on how much you're willing to pay at all. Trade confirmation, we'll go back to that. Every single time there is a trade that occurs in a match engine, it's not always a one-for-one, as we know. But when a market data message goes out, because, Joe, we don't do market by order, we aggregate the information. So on the market data feed, you might see a 10,000 lot just traded. But guess what? For the trade confirmations, you are sending out potentially 10,000 individual confirmations, or 5,000 if you just want to say there were buyers and sellers. So when we talk about the fact that there is inherently going to be variability, it's because of just pure basic physics and technology. So these are not the types of things that I think, when you hear about them, and what I think the Flash Boys book was referring to was the market data. The information that goes out to the whole world, you get different options for how you receive it. I think the information that's been discussed recently with CME Group and confirmations is different. And I'm not saying it's right or wrong. I'm just saying it's really important that we understand that they're two completely different things. And it's very important to understand that trade confirmations go back to only the people that were involved in the trade. Market data goes back to the whole world, so the whole world knows what trade occurred. Having said that, for the last, I've been with CME for 27 years, so I've seen the evolution of open outcry to electronic trading, to colocation, to faster markets, to demanding, different types of products and services. And I'll say that this evolution is not new. This whole idea of constantly improving your technology and constantly understanding what the needs of our customer base is and making sure that we're, bringing those two closer and closer together. This is an ongoing project that's been years and years and years in the making. So I'm very comfortable that, it's a focus for us, always has been a focus for us, and will continue to be a focus for us. And I'm very confident that I can say the same for pretty much every exchange out there with respect to technology and enhancements to technology. Some may act on it, a little more quickly than others, but it's part of being a technology-based industry. So that's all I'll say.
Walter? Walter's been patient at representing the SEC. He's might have something to say now.
Yes, I'm on the Data Standardization Committee, and what intrigued me very early on, Joe, your very counterintuitive remark that maybe it would be better if less market data were available. And the reason it's so counterintuitive to me is I'm part of the division in the SEC, is the Division of Economic and Risk Analysis. And as we try and do an ever better job of understanding market behavior, traded behavior, we're very much hampered by the lack of transparency in market data. So I understand that some uniformity would be a good thing. And I appreciate Brian's sort of forthright description of the relatively limited amount of data price orders. What I'm wondering is, though, are there not other commodity exchanges that are providing more, and does that provide an opportunity for arbitrage? And that conversation seemed to be starting this morning, and I just wanted to hear from ICE and other market representatives whether, in fact, there are substantial differences in the amount and type of market data. Thank you, Julie, for your elaboration of what is available to whom as a good explanation. But I'm just curious about the other markets that the CFTC regulates, and is there asymmetry in the amount of information provided by markets, and is it significant? So I'd like to start with ICE.
Sure.
Speak to that.
Sure. So on several of those topics, so we have, as Julie said, ICE has one price feed. There's no premium feed that anyone gets. We are order by order. Our markets, we have both futures markets and we've had OTC cleared bilateral markets on the same platform. And so there has been historical need to actually have more information on orders, where an order, given who the counterparty was or the trader was that was receiving the order, may be executable, may not be on a bilateral basis. So we are order by order. We have a price level price feed as well that we are considering moving to now, which would reduce some of the data that Joe's alluding to, specifically order by order information. We may move to that, but historically we've been order by order.
Walter, does that answer your question?
It does, although there are other commodity markets.
I think maybe in the next panel, we can talk about some of the cross-market. I mean, obviously the relationship between equity markets and futures markets, derivative markets.
No, I'm not defending equity markets this morning.
But nonetheless, I mean,
I'm genuinely curious about how this works between the commodity markets, because arbitrage is kind of where it's at.
Yeah, and I'm curious as to what our 21st century surveillance system may look like in light of the arbitrage opportunities and the different regulatory structures. So after Walter we're going to Larry Tabb, Steve, and then Richard Gorlick, Brad Levy, Nick Solinger, Jason Pope.
I don't have a real comment on the discussion. I just want to basically say, I think, the CFTC and the SEC has kind of historically looked at this kind of separately, and it kind of diverged, I don't know, maybe 15 or so years ago, maybe a little longer, with the whole idea of two major routes. One is around order flow segmentation and the SEC's view of kind of looking after the individual investor, and this whole idea of, we need to do good by the individual investor. And the second, I think, is around competition and fragmentation of the markets. So with the idea of, we need to give the individual investor a better price or a truer market, they went through this whole idea of starting to segment, order flow. And I think a whole lot of things transpired from there. When we started segmenting order flow, we can provide price improvement to different classes of investors. Then you start looking at toxic versus non-toxic order flow, and then we can start avoiding the toxic order flow and kind of focusing on the uninformed order flow, and then the issue of are centralized markets, do they have too much power, and then we start breaking them apart, and then you wind up with this kind of view that we need to try to segment and understand and certain monetize or understand the financial impact of a stream of order flow, and that goes into RLPs, and now this whole idea of institutional liquidity programs, and you wind up with finer and finer grained liquidity, which to some extent, in some cases, if you're a retail uninformed investor, is good, but if you're trying to get stuff done and you're an institution, it may not be good. And you wind up with all these discrete liquidity pools that then you wind up having to either glue together or not glue together, and you wind up with this fragmentation challenge. So I would, if you want to keep a holistic market, you want to keep better surveillance, you want to try to understand exactly what's operating at every given, I would try not to go down that path. On the other hand, that path has provided a lot of benefits in terms of competition and cheap executions, but it creates other problems as well. So that's, I think,
make sure you stick around for panel 3 on our self-regulation. Next, Steve with FINRA.
Thank you. I'm not going to get into the equity fragmentation debate, but certainly equity fragmentation creates some unique challenges for the regulatory side of the business. And we've made some great inroads, as Chris referred to, the work that FINRA has been able to do to consolidate some of the regulatory activity across markets. And today we can actually see cross-market participation and strategies across those environments. But there are a number of differences in the equity marketplace. I'm curious to see whether they are problems for the futures marketplace. When we think of market integrity, most investors come to market today working not just across execution venues, but they work across broker-dealers, and they've done that for many, many years. As a result, understanding from a regulatory perspective what bad actors are doing or bad practices are, you need to reach beyond what's happening at the exchanges and into what the customers are actually thinking about, what their strategies look like. Those strategies, when they cut across multiple broker-dealers as well as multiple exchanges, creates a level of complexity that is difficult to get your arms around. CAT will bring us much, much further down the path. It may not be perfect, but there are many, many advances in CAT that will allow us to see things across investors in a way that we can't see today by bringing orders and executions reports and trade reports back to the ultimate investor and allow us to root out abusive strategies. I'm curious to hear what's happening here in the futures marketplace, and are you thinking that way? Do you see behaviors in the futures marketplace where investors reach across multiple dealers? Because I assume the points of execution that the exchanges are talking about that they can see are the dealer activities in. What about reaching beyond the dealers, and are there activities being done to reach beyond that effort in the futures marketplace? And when we get to the issues you talked about before in terms of cross-product behaviors, we can call it many different ways, that are futures and equities and options and bonds, we start thinking about regulation in those worlds, it's even more critical that we think about what customers are doing. So I'm just curious to hear what the futures marketplace is thinking about in terms of what they're doing there.
I'm not trying to dodge this question, Steve, but I think if we could hold that one for the next panel, Andrew will be speaking to the issue.
Thank you. I'm Richard Gorlick, CEO of RGM Advisors, a principal trading firm based in Austin, Texas. I appreciate the opportunity to participate in this dialogue as a member of the Technology Advisory Committee. I do want to comment that I've been on this committee since Commissioner O'Malley reconstituted it in 2010, and we've heard a little bit of this already today. And I will admit to some surprise that in 2014, we're still talking about some of the very issues we talked about at the first meeting, and the second meeting, and the third meeting. The Commission and this committee has certainly contributed to improving understanding by the public and by policymakers of the use of technology in markets. I'll limit my comments at this point to Vince's question a little bit earlier about where is there an appropriate area for the Commission to engage in some of these areas. And while I agree with a number of the comments made today about principles-based rules on risk controls, there may be an appropriate place in the market for these rules to come in and help make sure that there really are consistent risk controls across exchanges and across market participants. Also want to limit my comments at this point to the fairness topic that this discussion today relates to in this panel. And on fairness, I believe it is paramount that market facilities such as colocation and market data feeds are offered to the public on fair, reasonable, and non-discriminatory terms. I believe that to be the current practice, but I also believe that there is an important role for the Commission to monitor and assure the public that this is always the case. In addition, transparency is essential. Recent press reports, and we've talked about it a little bit today, have indicated that the Commission is interested in the terms of market making and liquidity provision programs offered by exchanges. In my mind, the conditions and terms of these programs should be transparently disclosed to the Commission and to the public, and there should be no secret pricing deals. To the extent that that is not the case today, reforms may be appropriate. I'll reserve some of my thinking on the surveillance issue for the later panel as well. Thank you.
Thank you very much. I want to continue on a little bit with what Larry was hitting on, which is the point on competition. And it seems like the debate today is about competition, which was part of the SEC's intent, maybe they went a bit too far in succeeding on fragmenting the market by regulations, ATS, NMS, et cetera. But that was their intent, and they should be applauded on some level for achieving that, albeit it arguably had gone too far. At the other bookend, there is an argument that simplicity is better from a regulatory perspective and a market surveillance and safety perspective, which there are definitely arguments, I think, that support that. The reality is in life, and probably in this debate as well, the answer is probably somewhere in the middle, where hyperfragmentation creates many negative unintended consequences, and the other end of the spectrum, very limited alternatives creates other negative unintended consequences. So I'll just make that point, and the SEC as a commission did take a view on that. I think there are elements of what the CFTC has done in the implementation of Dodd-Frank that lean toward that. But there could be a bit more work done around the preferred outcome from a regulatory perspective of where the right balance is between simplicity of market structure and competition. The other thing I'll draw just a point on, which hasn't been discussed today, is the difference between execution and clearing. A lot of this discussion today in equities, hyper-fragmented at the execution level and zero at the settlement and clearing end. And that is just at least something to think about when we think about the structure of derivatives futures versus the equities markets and the pending markets in the swaps world. And we've heard about some potential competition from that angle, but it's not clear that's really that's going to really push the market to a higher standard. And the final point I'll make is that ultimately this is all about transparency and not the typical type of transparency I think that people think about, which is data transparency, market, limit order books, access to information. It's really about transparency of the market structure. There have a couple of things that have come out recently. I think Goldman and Credit Suisse recently disclosed the workings of their dark pool, which was always considered very proprietary, and that is definitely a step in the right direction in terms of transparency that hadn't been mandated, but the market seems to be taking it on themselves to do it. We had a particular initiative in Hong Kong where the regulators demanded that algo firms submit to a questionnaire that says who they are and how they do what they do. And that's a version of what regulators can do to not necessarily prescribe it in detail, but prescribe something. And we just happened to be the firm that was selected to run that process to get the documentation and the whole system up and running by the end of the year last year. And then there's other tools like TCA, where it's really tools that allow market participants not to rely on what people tell them, but to actually know for themselves how their transactions are being handled in the market, whether they're moving markets, et cetera. And those are all tools that the technology firms like ourselves and others will provide to the markets. So there's some self-imposed, there's some that will be imposed by the regulators, and there's some that the market will just fill in. But ultimately, around all of that, the understanding of how competition should really fall out in the markets in general is just an important concept for the room in general and for the commission in particular.
So a lot of discussion here has been about sort of market structure issues, and we economists spend a lot of time thinking about it, but I'm sort of thinking about operational risk issues. The concept release that we issued and sort of received some comments, there are two aspects to it. One is sort of market structure issues, and another is operational risk issues. And I was just thinking about a comment that Brian and Chuck made in terms of how you inspect and sort of monitor those with direct market access. So I'm sort of, whenever you read about any glitch in the market or stoppage of trading, I constantly try to go to the bottom of the article to see if there's any mention of a software upgrade that happened. And 9 times out of 10, the glitch is typically caused by a software upgrade. Knight Capital is sort of a classic example, I guess. And the question is, where is the industry in terms of the exchanges, the FCMs and others, in terms of how you regulate, how do you sort of manage and mitigate operational risk issues? So if the exchange has done a major software upgrade, then you want the firms to come and test the systems. But what if the customers or the firms have done some changes to the system? At what point do they have to come and test it with the exchange, I guess?
Let's ask Rob that question.
Well, as indicated in the concept release, of all the principal trading firms that were surveyed, 100% maintain risk controls that address a lot of the concerns that were brought up today regarding max order size, messages to the exchange. Now, that's certainly not the universe of market participants, but it was a quick study going into that process of response, and it was refreshing but not surprising to hear that everyone went down that path. So I think a lot of participants are already going down this path. We internally we've produced as a group documents regarding best practices, which our member firms follow. The FCMs do hold all of the firms that are attaching to the exchange accountable. There's a vetting and an evaluation of your process and technology as you go through that. But there's no doubt we have to be vigilant anytime when we're addressing technology and make sure that we're trying to stay up on top of everything that we possibly can. But there's processes that are in place on the customer side. I certainly know that there's processes in place at the exchange level as well.
Yeah, I think the biggest benefit we have in managing operational risk is that vertical silo. I mean, if you read about incidents in the equity markets, yes, it's often a software upgrade. It's often some interaction of that software with some third-party software. I think the fact that we control as much of the end-to-end as possible, certainly there are ISVs and front ends and parts of it we don't, HFTs, parts of it we don't control. But I think the fact that we have as comprehensive a view as you can as the exchange operator and the clearinghouse operator allows us to manage that risk much better than we otherwise could. I think in terms of just general practices, we're in the process now with acquiring the life exchanges. We have a number of contract migrations going on, moving between clearinghouses, moving between exchanges, even across U.S. and UK jurisdictions. What used to be fairly complicated things, we've gotten quite good of it. There are extensive industry dress rehearsals that go on weekends before these type of things happen. New software upgrades. Software is available in user acceptance environments for weeks, if not months, before it goes live. ISVs and HFTs are very active on their own initiative in testing in those environments. And as I said, for major versions, we go through conformance again with them as well. I think in launch, our first goal in a software upgrade is to do no harm. Whatever new feature or new logic is going in, we want to make sure that we didn't screw something up by doing that. So everything that we design is designed to be off. And so when we want to make sure that on day one, just the software upgrade itself didn't create a problem. And then whether it's a new matching engine, new network, whatever it might be, then migrate to that after we know we got through the software upgrade. We make extensive use of beta approach, whether it's moving a smaller market to a new matching engine first, or even if we have new market routers, market gateways in production, even going through a beta phase with various groups of customers that will make sure that that's working properly in production as it should. So that's gives you a little flavor of what we do.
I was thinking back to just earlier this year that one of the FIA conferences, the exchange presidents were very focused on system safeguards, attacks on the exchanges, and the integrated nature of these market participants and their access to the exchange and how we guard against that, and thinking about recent or opportunities where the systems have shut down and we've had to think about alternate trading venues. And I'm sort of curious as to the exchange's perspectives. I know that's a little off topic, but related about the broader issue of system safeguards as it relates to vicious attacks on our trading environment.
It's an area that is continuously on the presence of our mind. And should be in the context of the level of sophistication of people that are out there to create cyber attacks or try to penetrate a system. I can tell you that from our perspective, we continue to develop and build upon our very robust global information security program. I mean, we have capabilities in place today that are effectively preventing people from trying to come into our markets. It happens, and we have effective, I think, protocols to safeguard ourselves in that regard. However, I don't think anyone can ever rest on any laurels in any way, shape, or form in terms of the continued development and investment in the protocols to safeguard these markets. Part of it is also very much incumbent on the exchanges and the market providers to have a comprehensive business continuity program. And it's something that we work very, we strive to test our methodologies and make sure that we're able to provide that continuity and have the redundancies in place if there is a failure of the system, that our backup facilities effectively take over. And I know that's a little bit separate and apart from what you were alluding to, but it's all related in the same vein.
I wanted to circle back real quick, I'm sorry, on the fragmentation topic, because obviously you guys may be dealing with this later when it comes to CEFs, and hopefully you won't have the same problems that we have, but we do have one more proposal which I'd like to throw out today for the SEC or whoever it may be. We're calling it a 3-300. Okay, so exchanges right now, market share wise, there's 5 of them that currently have more than 3% market share. So we would suggest that if you're operating your exchange for a certain period of time, and I don't know what that may be, if you can't maintain 3% market share, you should lose your exchange protected quote status. And on the flip side, when it comes to dark pools, thanks to the FINRA data, by the way, yesterday that was reported, we appreciate that, we're now getting insight on dark pool size. And it was really interesting that only 17 of them were over 300 shares, average trade size. And about 25, I think the count was, if I was correct, that are under 300 shares. So we would say that if you can't maintain a dark pool with at least 300 shares average trade size, well, you don't deserve to have a dark pool. And at that point, you lose your ATS license. If you were to do those 2 things, you would drop the fragmentation down to 5 exchanges, 17 dark pools. At least we're getting somewhere. Just a suggestion.
Thanks. I want to comment briefly on the discussion around risk controls, and I think the exchanges have done a lot of investment in risk controls on their platforms, and the state of the art has advanced considerably in the past 5 years. But we still see a lot of headline incidents on issues in many markets. I don't know, many of them have not been in the headlines in futures, but because we're in the markets, we're actually aware of numerous incidents involving electronic trading, generated losses in the futures market, in the foreign exchange markets, and in other markets that we work in. Many of those incidents are not captured effectively by on-exchange risk controls, and there are gaps that as an industry still should be focused on. A lot of the proprietary trading firms around the table are very effective at managing these because of their depth of experience in these markets. However, as we've discussed, there are far larger numbers of firms beginning to use automated execution capabilities that are less sophisticated and are smaller size. And we see significant risks. We've had the unfortunate duty to turn off trading on about 5 firms where just terminated, and a lot of near misses that we've seen. All of them have involved clients being within long-short position limits, but having intraday losses that are not well managed on an individual exchange. Or they've involved participants who are self-clearing and so aren't employing on-exchange risk controls, or they trade across so many markets that on-exchange risk controls don't accurately reflect their exposure to it. So it's very common for people to trade treasuries against treasury futures or foreign exchange against currency futures. When you have those correlated trading strategies, those are the places where a single exchange has a very limited ability to capture what's going on. And we've seen those are the places where we've often seen the losses incur, where we've had to terminate trading activity for automated traders. Another point of note, this is not a high-frequency issue. This is an automated trading issue. A number of the incidents that we've seen have been people using commercial, off-the-shelf algos, and they've been directional, real money, low-risk profile types of clients that are relying on commercial tools. So, software has defects and will fail eventually, no matter what you do on the weekend upgrade.
I have two questions. I hope that's okay. Should be fairly quick here. One's a clarifying question, I think, for either Brian or for Julie. I think I heard the answer earlier, but I just want to clarify here. The common ID or static customer ID or something similar, that's not shared in any form in market data? Is that correct? Okay, thanks. And then the second question, can somebody explain it, and probably in simple terms, why it's believed that colocation eliminates all of the problems or many of the problems in the futures market?
I'll start and Julie can jump on. First of all, I don't know all the problems that you're referring to, but let's just talk about colocation and what it has been designed to do. Colocation is not in place to cater to a specific segment of market user. And in fact, it's utilized by all segments of users that come into our marketplace. How do I know that to be the case? Part of it has been the principles with which a colocation facility operates. And so when we designed our procedures and our policies for becoming a part of or utilizing our facilities, we did it with the idea of providing a very open and transparent playing field for people to come in to be able to have access if that is an area of interest to them. And it's not an area of interest to all market users. We work very closely with the CFTC in developing, our principles in terms of accessibility, pricing, contractual terms to make sure that everybody abides by the same principles and criteria for coming into the facility. The access to the platform itself was designed in such a fashion that no matter where you're located in the facility, your connectivity to the platform is exactly the same in terms of the connectivity. So there's no benefits in terms of distance. In terms of people's general access to the system, we have a multitude of service providers that are inside the colocation facility. We have a multiple of FCMs, intermediaries that are in there. And so they're providing that access to the overall broader client base. So plenty of times I'm sure that customers don't even realize they're in colocation facilities in terms of their orders and how their orders are being executed. It takes away a potential inequity by, in the past, having the closest real estate to an operator, an exchange operator, or a data center, or in the past, there was a land grab for real estate in and around data centers because people viewed that that might give them greater speed or access to the marketplace. And so from that perspective, the tenants that I outlined, we feel very strongly has leveled any inequities or playing field with that respect. Julie?
I think it might be useful to kind of contrast our situation in the context of colocation. I mean, we're in a third-party data center. ICE is both our primary and our DR sites. We actually added a colocation suite a number of years ago because in this third-party data center, it was filling up. And so any of the HFTs that were trading in our markets then, they had their own suites in the data center. And we became concerned that new market participants would not, if they wanted to colocate, they wouldn't have that option. So we took out a space ourselves, began subleasing that to HFTs or anyone that wanted to colocate. It's not just HFTs, and it's still a pretty small enterprise. I think we have far more HFTs connecting to us who are not in our colo suite than are in our colo suite. So again, for us, it was meant to just make sure that people could get in there if they wanted to. We don't make a lot of money from it. It's not a big business for us. And again, it's not in our exchange cage. It's in a separate cage. I want to make sure that people have this kind of uninformed illusion that somehow these guys are in the same rack with our matching engines.
I think
It's
a certain
completely
author said they
separate
were
cage.
in the exchange.
Yeah,
so.
in the exchange. They're not in the exchange.
Can I, there's an issue regarding whether it's spread network or microwave between equity markets and CME, in fact. The microwave, that gets dumped into the colo facility, or does that go directly into the exchange? So does it get that spooling?
Yeah, people have obviously several options of how they want to transmit data. And microwave is just, it's not even the newest anymore because there's even newer technologies out there, but microwave was the newest. Microwave goes to Aurora, which is the CME data center, and it goes to CERMAC, which is the data center that ICE is located in, the third-party data center. But what it doesn't do is go into our facility. So you can beam the information through microwave towers across state lines, but the way that you get into our colo facility is through fiber. So the same way everybody else has to get into our colo facility. Once you're in our colo facility through fiber, it runs exactly the same way that it would for anybody who's in that facility, and it is spooled. And the other point I want to make about our colo offerings is that we don't allow that to go, it goes into our data center and then it can get to our match engine through a normal fiber feed. So I think people thought that the microwave went directly to match engines. They don't. They go to, in our case, they go to a fiber feed that then goes into colo that then gets routed through the normal means.
Great, thank you. Greg?
Thank you very much, Commissioner O'Malley. I'm Greg Wood. I work for the FCM business at Deutsche Bank Securities here in New York. I'm also the president of the FIA Market Technology Division. And I was very honored to be invited to be part of the subcommittee for the CFTC TAC on automated trading and high-frequency trading. I just wanted to comment on a couple of things, general themes in the conversation so far today. Firstly, I have to compliment the CFTC in being so open in these discussions, and particularly with the release of the concept release back in September. That was a great opportunity for many of us within the industry to provide feedback on various points that have been touched on today. In particular, around principles around quality management of software development and deployment that apply to all participants, not just principal traders, but also FCMs and third-party vendors who provide various tools that allow a multitude of participants now to interact with the futures markets in an automated manner. And that includes corporates, that includes pension funds, asset managers, etc. Automated trading is very well utilized across the futures industry now by all participants. Also, the concept release touched on risk management, and it's worthwhile highlighting that I've sat at this table previously with regards to CFTC Regulation 173 that actually mandates that FCMs have to put risk management controls in place. Now, those risk management controls consider various levels, and we do utilize exchange controls, as Brian says, they're mandatory, but we would use them definitely for participants. And again, there's a variety of participants that would access the market directly, and we rely on exchange controls to provide that level of risk management, but also then feed back into the holistic risk management controls that we have at the FCM. One of the other points that was brought up in the concept release that goes back to our very first involvement within this committee was a definition of high-frequency trading. And we came up with a definition that was very mechanical in the way that we talked about various aspects of high-frequency trading, because most of us within the group, with some of us dissensions, felt that high-frequency trading is a tool. It's not necessarily a categorization of a type of participant. And I think we've had some criticism over that definition, but I think it's good now that we put that out there, because it means it doesn't mean that there is a type of participant that is labeled as high-frequency trading that is performing a certain type of activity. I think it's helped with the discussion that there are many types of participants who use automated trading, who can interact with the market in various ways. And one of the things that we wanted to emphasize when we came out with that definition is moving away from trying to look at types of participants and categorizing participants, but looking then at types of activities that may be abusive or disruptive. And it's very good to see that the next panel after this one will be based on surveillance, because that's where we really felt that the emphasis should be, and that surveillance systems should keep up with the speed of the markets and the amount of data that is generated. Thank you.
Yeah. So just to touch briefly on the concept release, we have taken in all the comments at the last TAC. Was it the last TAC? I think so, where we had reopened for receipt of additional comments, and we've taken all those in as well. We're currently working at the staff level. Sebastian and Rachel are back here in the corner, talking to the other divisions to come up with a recommendation. So we would bring forth to the Commission an evaluation, a summary of the comments that we've received, and a recommendation about whether or what further steps we should take broadly in the categories of these pre-trade risk controls that we were talking about, whether or how there should be some registration component required or suggested, the system safeguards, and increased level of reporting obligations. Is that something that we should also take on or require the markets to do? There was certainly a lot of comments about using principles versus prescriptive, and recently I was called to testify before the Senate to sort of talk about those differences. But we are getting closer, at least internally at the staff level, on a recommendation that we'd like to discuss with the Commission.
Yeah, real quick. Well, first, for the record, I just realized no one wants to sit next to me. I think it might be my HFT label on my panel. Just on risk controls, again, there was some discussion around system changes, and I think that's a critical topic, because obviously the evidence does reflect that many of the problems that we've had in our market do involve some system change or system enhancement. The PTG group did put out a fantastic paper on best practices, something that everyone should take a look at. But I think in topics of risk controls, if you're properly writing rules around risk controls and pre-trade controls, it should be built to assume those breaks, because software isn't the only thing that breaks. Hardware breaks as well, and you can't predict what happens when hardware breaks. So risk controls are designed to capture not only bad software, bad algos, bad behaviors, but they're also designed to capture system outage or system issues that create that kind of activity. So when you design risk controls, you should have in your mind that you're going to have software issues and hardware issues, and that's part of the element of these pre-trade controls that should be considered. One thought I had in terms of testing and testing environments, the exchanges do a fantastic job of providing a test environment where participants go in and test whether they have new code or the exchanges introduce new code. Something that was introduced, I hate to say, in the equity world, we could actually learn something from that world, is the concept of a test contract or a test symbol, where the exchanges would introduce a contract that is not a real contract, sits in its production system, and participants can test that contract on a production system. Because the one flaw in testing in a test environment is just that it's a test environment. You still have to reconnect to your production gateways, your production connectivity, and it's not a perfect test, so to speak. And so there's an additional element where people have introduced testing contracts or testing symbols that are sitting on the production system, protected from hyperactivity around testing, but it does give you a wonderful production test without a real contract or a real market.
I have one more question regarding to separate kind of this discussion on maker-taker and some of these fees. I'd like to get a better sense of how the exchanges, the futures exchanges, deal with either participant fees or rebates. And I would note that in 2010, there were a total of 56 market maker and incentive programs filed with the Commission. In 2013, that total had gone to 341 programs. I'm kind of wondering what the factors are that have contributed to this increase, and how do exchanges determine whether to implement a market maker program for what product, and how do you define a successful market maker and incentive program, and what might lead to its termination? So help me understand the thinking of these programs, why we go from 56 to 340, and how do we ensure that they're good developments for the market?
Hey, first of all, Commissioner, I'm not totally sure in terms of the numbers that you just outlined, okay? But I can say this, I mean, in the context of filing, I know that those are not all new programs. They're modifications that were made to existing programs, and I'm imagining the same holds true for ICE. So there's new programs, modifications to existing programs. As to my earlier comments, just to reiterate, let's just level set. There's a distinctive difference between what we've heard in the equity markets and what occurs in the futures markets. I just need to reiterate that. However, in the context of how we decide to employ programs, it is really in the context of developing markets and building liquidity in markets. So there's maybe a need in the context, or there is a need when we're developing a new product and bringing in a new product into the marketplace. It is not a stock. It doesn't exist somewhere else. It's conceived, through the intellect and the development of our research people, meeting a risk management need that we find in the marketplace. Going to market with that is very part and parcel to working with the trading community, ensuring that we have a product to go to market with and have capabilities to build markets for other market participants to come to a centralized pool of liquidity to be able to trade. And so in building up, that liquidity, we have, found it very effective to have programs in place in which we have market makers as a portion of that to be there and provide markets, throughout the trading session, continuously providing bids and offers, and have a responsibility to abide by criteria that we set out in the context of depth of market, the size of the bid offer, the spread, and giving them incentives in the context of reduction in fees, volume incentives to build up a marketplace once that essential basis of liquidity has been developed, continuing to build upon that and have that continuity of, again, deep liquid markets for participants to be able to come and rely on around the clock. We look at these programs continuously. You obviously see that we make changes to programs, and we file those programs to the CFTC. CFTC will have questions from time to time. We respond to those questions, and then we go forth in adopting the programs. The programs themselves have very specific criteria in order to be able to be a participant. That criteria and the programs themselves are not only filed with the Commission, but they're also posted on our website. When we look at programs and participants, we certainly look at it in the context of, is it achieving the end result and the goal of building up liquid and vibrant markets? Are they the criteria themselves well defined? Yes. Do people have the opportunity to participate in these? Can they look at a venue in terms of our website, in terms of what might be available there and what product base and for what purpose? Yes. And then as we go along, we certainly monitor the efficacy of the programs, and at times we eliminate them. Or if parties to the arrangements are not fulfilling their obligations, yes, then we remove them from the programs.
Yeah, I was just going to say, I think somebody alluded to earlier, we're both for-profit companies, so I can assure you neither ICE nor CME have any program or any fee discount that it doesn't think is absolutely necessary to either build or maintain a market. And like Brian said, we're constantly reviewing these. We're reviewing the participants in these programs. Are they meeting the obligations? Should they be removed from the program? Should the program itself be moved or changed? I didn't catch the time frame of your two comparisons, but we did, as you recall, ICE had a large over-the-counter swaps market that became futures. There may have been a slug of incentive programs that came across with that. I don't know, but I think in addition to things like starting a new market, building the options in a market, focusing on the front 3 months, focusing on the back months, there's a healthy amount of trying to compete with a comparable CME product, which I think is good for the marketplace. We as CME, we have to file each of these programs with the CFTC. They're on your website. They have start dates and end dates. At the end date, we may renew it, we may discontinue it, we may change it. And the profit motive keeps us very interested and on top of those programs so that we're not paying someone to do something. Either they're not doing it or it's just not effective.
All right, we've reached the end of panel 1 discussion. Are there any final words or comments anybody would like to make? Anybody on the telephone? All right, with that, we'll take a break. And what time are we coming back? 1:30. All the people seated at the table and our witnesses are invited to join us for lunch upstairs on the 9th floor. We'll have staff take you up there. Thank you.